Ever wish you could, like, peek inside the mind of an investing legend?
Yeah.
Well, that's what we're doing today,
Here.
a deep dive into the wisdom of Warren Buffett.
Cool.
But, and here's the twist, we're not just looking at his wins.
Oh.
We're diving into his warnings, the mistakes he says even seasoned investors make.
And you know he's got to have some good ones. I mean, this is the Oracle of Omaha, right?
Exactly.
The guy who took Berkshire Hathaway, which, let's be honest, was a struggling textile company,
Right.
turned it into a trillion-dollar powerhouse.
$1 trillion. It's mind-boggling. And his track record,
Legendary.
an average annual return of 20% over 6 decades.
Wow.
Now, compare that to the S&P 500, which brings in, what, about half that?
Yeah, around there.
And year after year, that difference in growth, it compounds and it snowballs.
It's huge. And what was really interesting is Buffett's been making some big moves lately, like he's not afraid to shake things up.
Oh, tell me more.
Well, he recently sold off a big chunk of his Apple stock.
Apple. Wow.
Yeah, and then he bought Chubb Insurance, which, insurance, that's a whole other game.
It is.
But here's the real head-scratcher. He's sitting on a mountain of cash right now.
How much are we talking?
$300 billion, the largest we've ever seen him hold.
$300 billion. It makes you wonder what he sees coming, doesn't it?
It does. It makes you think.
So, in this deep dive, we're not just celebrating Buffett's success. We're looking at an article outlining 12 investment mistakes he warns against. These are the traps, the pitfalls, that can trip up even the most experienced investors.
Especially during uncertain times like, well, now.
Exactly. So, mistake number 1, and it's a big one, trying to time the market.
Oh, that's a classic.
Buffett says it's a fool's errand. You can't predict the market's short-term swings.
Nope.
No one can, not even him.
He's got a great analogy for it. He says it's like being on a voyage at sea. You can't control the weather, right? The storms, they come and go. So instead of trying to predict those waves, focus on being on the right ship.
A ship that can weather the storm.
Exactly. One that's built to last.
Makes you think about the pandemic crash, doesn't it? People were panicking, selling off left and right.
Oh, I remember. It was crazy.
But Buffett, he rode that wave, didn't flinch.
He held steady. And that's because he focuses on finding fundamentally sound companies, those with strong financials and a solid track record. Then he holds on to them.
For the long haul.
Exactly. He's not trying to time his entry and exit. He's in it for the long game.
Okay, so lesson 1. Forget trying to outsmart the market. Focus on finding those rock-solid companies.
Exactly. Invest in quality. And that actually leads us right into mistake number 2, obsessing over the purchase price.
Really? How so?
The article gives this example of 2 investors, Aho and Amin, both buying shares of NVIDIA. Let's say Aho gets in early, snags a much lower price per share.
Okay, so far so good for Awa.
Right. Now, Amin buys in later, after the stock has already climbed quite a bit.
Paying a premium.
Exactly. But here's the thing. Let's say from this point forward, NVIDIA increases in value by 50%. They both gain 50% on their initial investment.
Doesn't matter what they paid initially.
Exactly. The market doesn't care what you paid for a stock yesterday. All that matters is what it's potentially worth tomorrow. It's like that old saying, don't cry over spilled milk. What's done is done.
Okay, that makes sense. So don't beat yourself up over past purchases. Focus on making smart decisions moving forward.
Precisely. Now, are you ready for mistake number 3?
Hit me with it.
This one's all about unrealistic growth expectations. We all dream of discovering that next rocket ship stock, the one that's going to skyrocket in value.
Who doesn't?
Right. But Buffett warns against getting caught up in the hype. You see, companies, they love to make promises, boasting about their projected growth, 15%, 20% annual growth. It sounds amazing.
It does sound pretty tempting.
It does, doesn't it? But sustaining that level of growth over the long term,
Not so easy.
it's incredibly rare. Think about it. In the last decade, how many companies listed on the S&P 500 do you think achieved an annual growth rate of 15% or more?
I don't know, a lot.
About 10%. Just 10%.
Right.
That's it.
Wow, that's a reality check. So due diligence is key.
Right, absolutely. You've got to look beyond the hype.
Dig into those financials, see if those promises actually hold water.
Exactly. Don't get swept away by a compelling story. Look at the facts, the fundamentals. Now, are you ready to get a little risky?
Oh, riskier. I'm intrigued.
Mistake number 4. Overusing leverage.
Ah, leverage. Now that's a whole other beast, isn't it?
It can be. In essence, it's borrowing money to amplify your potential returns.
Okay, so high risk, high reward.
It can be. Buffett compares it to financial Russian roulette.
Okay, I see where this is going.
If you leverage your money, And your bet is right. You could see incredible gains. But, and this is a big but, if you're wrong, well, let's just say the article tells the story of this one investor. He leveraged a large percentage of his retirement savings. And at first, things were amazing.
Telling it.
Exactly. But then the market took a downturn.
Uh-oh.
And he got hit with margin calls. To cover his losses, he had to sell his assets at a loss. In the end, he lost 85% of his retirement fund.
85%. That's devastating.
It is. And it's a stark reminder that leverage is not for the faint of heart. It magnifies your gains, but it also magnifies your losses.
So unless you're fully prepared for the potential downside, probably best to steer clear.
I would say so, yes. Now, get ready for this next one because it seems a bit counterintuitive. Mistake number 5 is focusing too much on the details and missing the big picture.
Wait, you're saying sometimes more information isn't better when it comes to investing?
That's exactly what Buffett suggests. He believes in keeping things relatively simple. When he evaluates an investment, he focuses on 3 core things.
Okay, and those are?
First, the industry the company operates in. Second, the quality of its management team. And third, the stock price. And there's actually a great story about Buffett acquiring a company after just a 15-minute meeting. He cut through all the noise and focused on those key drivers of value.
Wow, 15 minutes. He must have really known what he was looking for. So what you're saying is sometimes we get so bogged down in all the nitty-gritty, all the data, that we missed out on really amazing opportunities.
Precisely. Sometimes a straightforward, common-sense approach can be the most effective, especially when it comes to making those timely investment decisions.
Okay, I like it. Simplicity. Now, this next one seems a bit counterintuitive, too. Solving complex problems. I mean, usually you want to be able to solve those, right?
You would think so, wouldn't you? In so many areas of life, that's true. But Buffett, he suggests that when it comes to investing, sticking with simplicity is often the smarter play.
Really?
It's like that idea of Occam's razor. The simplest explanation is usually the right one.
Okay, so in the stock market, simpler is often better.
Exactly. And I think a good illustration of this is the downfall of long-term capital management.
Oh, wasn't that the hedge fund that had like a bunch of Nobel Prize-winning economists at the helm?
It was. They were the rock stars of the financial world, using all these incredibly complex mathematical models to try to beat the market. And for a while...
They were on top of the world.
Oh, yeah. They were generating some seriously impressive returns. But then the market shifted in a way their fancy models hadn't anticipated.
Oh.
And it all came crashing down. In a single month, they lost 90% of their capital.
90? Wow. Talk about a reality check.
It was. It just goes to show that complexity doesn't always equal security. In fact, it can sometimes create a false sense of security. Sometimes those fundamental principles, the ones that have stood the test of time, those are the ones that often win in the long run.
Interesting. Okay, so maybe sticking with what we know, what's tried and true, isn't such a bad idea after all. I think it's a powerful reminder that even the smartest people can overthink things. Sometimes simplicity wins, especially when it comes to investing. All right, you ready to dive into the next batch of Buffett wisdom?
Let's do it.
All right, mistake number 7 is narrowing your opportunity scope. Buffett, he's all about keeping an open mind, exploring all sorts of investment opportunities.
It's like that old saying, right? Don't put all your eggs in one basket. You could miss out on some amazing opportunities if you're too focused on just one thing.
And this is coming from the guy who bought a struggling textile company, and, well, you know the rest of the story.
Right, Berkshire Hathaway. I think it goes to show that you can find opportunity in the most unexpected places.
It's true. Now, this next one really resonates with me. Mistake number 8 is staying too active. We have this instinct to constantly be doing something, right? To feel productive. But when it comes to investing, is that always the best strategy?
That's a great question. It can be so tempting to feel like you need to constantly make moves in the market, but Buffett, he's all about patience. He says it's like a batter waiting for the perfect pitch.
Okay, I like that analogy.
You don't swing at every single pitch that comes your way. You wait for the right one.
You wait for your pitch, that perfect opportunity.
Exactly.
Yeah.
And in investing, that means taking the time to find those opportunities that align with your goals, understanding them, and then having the conviction to hold on.
So it's about being strategic, not emotional, don't get swept up in all the noise. Speaking of which, let's talk about mistake number 9, which is over-diversifying. Okay, we all hear about how important it is to diversify, to spread that risk around.
Right.
But when is it too much of a good thing?
That's the million-dollar question, isn't it? Diversification is crucial, don't get me wrong. You don't want to put all your eggs in one basket. But Buffett, He warns against taking this too far. You don't need to invest in everything under the sun.
Okay, so be smart about it.
Exactly. Focus on building a really solid portfolio with companies that you understand, that you believe in, and that you're comfortable holding for the long term.
It's like building that greatest hits portfolio. Only your favorite, most trusted investments make the cut. Now, get ready for this next one because it's a bit of a mind bender. Mistake number 10, confirmation bias.
Ah, yes, confirmation bias. We've all been there.
We have. I think we'd be lying if we said we hadn't. But how does this play out in the world of investing?
Well, it can lead to some less than ideal decisions, that's for sure. It's so easy to get attached to our initial assessment of a stock, right?
We fall in love with the story we've told ourselves.
Exactly. And so we might overlook those red flags, those little warning signs, or we might dismiss information that contradicts what we want to believe.
We only see what we want to see.
It's like we're searching for evidence that supports our initial idea instead of looking at the whole picture.
So we're actually working against our best interests.
It happens to the best of us. I love this analogy that Charlie Munger, Buffett's business partner, uses to describe confirmation bias. He compares it to, get this, a human egg and sperm.
Okay, I'm intrigued.
Once that single sperm gets inside the egg,
It closes up.
right, no other sperm can get in.
The egg is like, nope, we're done here.
Exactly. And our brains can work the same way. When we get stuck on an idea, when we let confirmation bias take over, we close ourselves off from alternative perspectives. But in the world of investing, being receptive to new information, even when it's not what we want to hear, that's so important.
It's about keeping an open mind. Okay, down to the wire now. Mistake number 11, following the crowd.
Oh, yeah. This one's a big one, especially in today's world, right? Social media, news, it's everywhere.
Everywhere. So how do we avoid getting caught up in all the hype?
Buffett, he warns against buying into something just because everyone else is. He says often by the time something is super popular, when it's the next big thing, it's usually too late.
You're buying high after everyone else has already made their money.
Exactly. The legendary investor Howard Marks, he said it best. He said, what's obvious is almost always wrong. So true.
So maybe being a contrarian is the way to go.
It can be a good strategy. Think about it. Buffett and other successful investors, they often zig when everyone else is zagging. They do their own research and they trust their own judgment.
So don't just follow the herd. Do your own homework. All right, last one. Mistake number 12 is a tough one because it's all about inaction. Knowing the right move, but not acting on it. Is there anything more frustrating than that?
I don't know about you, but that's one of my biggest regrets, those missed opportunities. And Buffett's no stranger to this either. He's admitted that some of his biggest regrets came from those moments when he hesitated.
He let that hesitation cost him billions.
Billions with a B. Talk about a missed opportunity. But it really highlights something important, doesn't it? That fear of making a mistake, that fear of pulling the trigger, it can be paralyzing.
It's easier to do nothing sometimes.
It is. But even the best investors, even Warren Buffett, they've made mistakes.
So it's not about being perfect. It's about learning and adapting.
Exactly. Refining your approach as you go and not being afraid to take a chance, a calculated risk, when you believe in the opportunity.
This whole deep dive has been amazing. It's like a masterclass in smart decision making, not just for investing, but for life in general. But how do we actually use this information? I mean, it's not like we can just memorize these 12 mistakes and magically become investing gurus, right?
Right. It's not about memorization. It's about understanding the why behind those mistakes.
It's the psychology of investing.
Exactly. Recognizing our own biases,
Yeah.
those tendencies we all have, and then having the discipline to stick to our strategy even when things get a little crazy.
Easier said than done sometimes.
It is. It is. But remember, Buffett, he emphasizes simplicity. Focus on what you understand.
Tune out the noise. Be patient.
It's not just a virtue, it's an investment strategy.
And you know what I love about all of this? These principles, they go way beyond the stock market.
They really do. We've been talking about Buffett's stock market moves, but these ideas, they can be applied to so many areas of life.
It's like Buffettisms for life. Think about your own financial goals. Are you thinking about buying real estate? Maybe starting a business? Those same principles apply.
Patience, due diligence, understanding value, not following the crowd.
It's about making smart decisions, informed decisions. This deep dive has been incredible, but now we want to hear from you. What really resonated with you today? Head over to our social media and let us know.
We'd love to hear your thoughts.
Until next time, remember, sometimes the smartest move is knowing when not to make a move at all.